Um, Firstly, I would like to welcome each and everyone. Thank you for your time, and I hope that there will be something that you everyone will at least take away from this session. What I will be covering in this session broadly will be to talk upon financial planning, what type of impact it can have on your life, and largely I will be covering topics like goal setting, what type of insurance is what you need, what type of investment planning is required, and I must firstly thank the AIWMI, that is the Association of International Wealth Management of India, who has taken up such a noble initiative, which is actually targeting, to expand financial literacy on the country level, and it's going to have, a good impact over the long run. So let me begin. Firstly, just a brief background about myself. Uh, Devesh Mundra. I am a chartered accountant, financial risk manager, FRM, certified credit research analyst, and an alternative investment manager. I'm working with the Anand Rathi private wealth vertical of Anand Rathi Group, where our primary work is to manage money and estate of HNIs in India and abroad. So, having said that, let's move forward with the topic of our, the session. The most important thing, I would like to bring your attention to is this picture. This picture actually, if you see, in itself can summarize what financial planning is all about. You see, you have your goals under the umbrella, your education goals, your travel goals. Maybe you want a luxury car, or maybe you want to marry very soon, you want to buy a big house. These are all your goals, your aspirations, your dreams. This is what you actually are aiming for. Now, what happens is the raindrops that are falling above the umbrella, the problem happens that the raindrop is actually the the external factors, the market movements, maybe the economy is crashing, or maybe someone dies, the family person who's the karta of the family, he dies suddenly. What happens is we need to understand that as an individual we need to be protected from such unforeseen events that can take place anytime during your life journey. This umbrella that you can see, which is trying to protect your goals and ambitions and desires from the rainfall, the external factors, this in itself is a financial plan. So this umbrella is an actual financial plan for you, which can take care of all the problems that affect your goals in the long run, right? Now what happens is that when I meet a lot of people and I interact with a lot of people, they tell me that, I don't earn that type of money, which actually belongs, which actually requires that type of attention, or that type of planning, that type of monitoring. I don't earn that much. I just It's a very nominal salary that I earn, and I don't belong to a rich family. So okay, let us do a very simple exercise. What if I tell you that if you just start saving a reasonable 20,000 around per month, and I'm sure we all are almost at the age where we are planning to start a career, or we must have started our careers not later than last 3 to 4 years, and we are targeting to work for another, say, 30 years. But what if I just tell you, let's save around 20,000 per month, and let's do it for 15 years, and let's target a reasonable target return of 12%. And mind you, this 12% is a very reasonable target. The biggest indices of this country have actually given an average 14 to 15%. I'll talk about that later, but this is a reasonable target return. We are not expecting some high fundu 20-25% return, and a nominal 12% return, 15,000 per month, 20,000 per month for the next 15 years. What do you think you will be left at when you end this journey of 15 years? What will be the money pool? Right? And I'll also tell you that the amount that you try saving in the next 15 years, 20,000 per month, is going to be 35 to 40 lakhs on an average. This is what you are going to save from your own pocket. What will happen is after 15 years, you will end up becoming a crorepati, right? You will have around 1 crore with you if you do this simple exercise. Now, the idea is not to guarantee something or not to tell you that this is a foolproof plan, but at least this is a plan. What is the other thing that you have thought about to actually reach the first crore of your life? And this one is quite achievable. If you try saving just 20,000 around per month, then this journey you will be able to actually have the fruits also in the next 15 years. So never assume that your salary is not that high, or you don't belong to that rich family, or your money is not that big that deserves that type of attention. No, that's not true. I've seen people who belong to this category, who have a lot of high salary bracket and a very rich family. But then if they don't plan their finances well, I've also seen them going broke in the near future, or maybe in some years, 20, 30, 40, whatever it is. So that is something that I'm trying to say, that if your salary is not that high, you don't belong to that type of category, that's not a problem. Savings can do wonders for you. So okay, this is enough of knowledge. Sounds good to me, saving for the next 15 years and becoming a crorepati. So what should I do now? That question of what to do now. So let me come back to my topic, financial planning. The buzzword of this entire session has been financial planning. And what are we supposed to understand by this topic, financial planning? So see, the word money in a financial plan comes only in the end. Financial planning is not only about money. It's actually about understanding your life goals. Okay? It's about understanding what are your priorities. It is about understanding what are your desires. Right? Once you understand all this, you need a disciplined and a planned approach. You need constant monitoring, which will be done by money. So money is the resource that we will use, but the aim is to actually plan your life and understand what are the things that you want in life and what is the thing that we must do, and the process or the path or the disciplined approach that we need to follow using your money. I've given a simple formula. Financial planning or a financial goal is simply equal to CR plus IO. That means the current resources that you have, that's the money pool that you have, and the investment options that lie in front of us. The combination of both these things will ensure that you reach your goals. Okay, so I'm impressed by this. Sounds good to me. I want to plan my life, I want to plan my desires, and I also want to achieve them one fine day. What should I do? A suggestion is, let a financial planner do it for you, because that is the work that he does day in, day out. You must be busy in your own job. You must not be getting your own time to manage finances, and there are chances that you might also not understand each and everything that's happening in the market, that's happening in the economy, that's happening with different product classes. So it's better to at least hire someone who can do this work for you. And if you want to take that step of hiring someone, what's the first thing you need to do is the pre-work. Pre-work means you just need to actually start collating whatever information you have about your existing investments that you have done till date. Say your FD receipts, your mutual fund documents, or any type of gold that you are holding, your real estate. Just collate them, arrange them in one file, and then approach someone who is an expert in this field. In the same way you are expert in your own field, let's approach someone who's expert in their field and let them do their work. Right? Now, what happens is, a lot of people try to skip this. This sounds, like a, that why is it so compulsory? I can understand things. I am well qualified. I have seen the world. I've seen everything. I don't think I need someone. So what happens is, I'll show you two types of, the two types of areas where people fall broadly. Where what I have seen is there are broadly these two types of category. These are two pyramids that I am trying to show you. These pyramids, actually, if you see the lower pyramid is actually something that's like a risky foundation that a lot of people end up making for themselves. Now, what I mean by risky foundation is something that when people invest, these are the two things that they look at. The options they look at are these two options, and those are the insurance and investments. See, insurance also as a subject, if I have to tell you, there are two types of insurances. One is an insurance that gives you only protection oriented insurance. There is something called as an insurance which is a ULIP, which gives you protection as well as a saving. So let us first understand that insurance is something that is required to give us protection, and the ideal way to deal with the protection is to buy an insurance which gives only protection. Let us not ask one product that's an insurance to do both the things for us, to give us returns also and to give us protection also. So that's not a fair thing. There are some drawbacks with these products because these products generally end up not deliver the best on both the ends. So if you want protection, let's go to an insurance which gives only protection. Largely people follow under the lower pyramid. That is, whatever money they have, the surplus money, they'll contact their LIC agent, they'll contact their other private insurance agent companies, they will get random calls from them, and they will try to sell some type of policy which says, okay, sir, you can invest for 10 years and we'll give you a lump sum amount at the end, that is the 15th year or maybe the 20th year. But that's not a good idea because of some drawbacks. And then the money that they are left with, they go and proceed with investments that is also not planned. It's a random allocation of investments that they do in the end. The ideal way that a financial planner should take consideration, and as an individual, being a financially sound person, you need to understand that the upper pyramid, which I'm showing you, consists of a few slabs like goals, net worth, insurance, emergency funds, debt reduction, and then the investment. So let me go step by step. Let me touch one point at a time. Now let's start with goal. Financial planning, I know it should all be about money, but then the goal is the most underrated thing that I have ever come across. It sounds very childish, okay, I know what I want to do, but let's be concrete. Let's be concrete. If we know that there is something that we want in our lives, and we are talking about the financial goal right now. Everything requires money in the end. If you want to buy a big house, if you want to buy a big car, anything, you need money for that. So what's the idea? The idea is that write down your goals. Write down your goals, because when you write down your goals, you come to know that, okay, this is the thing that you wanted to do. This is the thing I want to do, and you'll stick to it. Because we are actually living in a time where there is a over bombardment of information. Your goals can keep changing every day. You'll receive some new information every day. You'll receive some new suggestions, some new tips. Hence there are high chances that you might just slip off from your goal, whatever the goal you have set. Hence it's advisable to actually write them and stick to it. Also, it's important to actually time specify your goal. What is the short term goal? What is the medium term goal? What is the long term goal? Because a lot of times, say for example, if you had planned your education abroad, you wanted to go to your do your MBA or something like that. Now if it's a short term goal, say maybe you want to end it in you want to go abroad in the next 1 to 2 years, then we need to plan investment avenues for you which actually give you that type of money that can come out in the next 1 to 2 years. We cannot go and block our money for 5 years or 6 years like an FD, wherein your short term goal was to go abroad and you end up randomly allocating money without thinking about the short term and medium term and the long term goals. And then the last thing about goal planning is prioritizing. As humans, we might have numerous desires, numerous aspirations in life, but always remember something, that due to practical reasons and due to the practical capacity of this universe, we need to understand that we might not be able to reach and achieve all those that we desire, all those things that we desire. Hence, prioritize the top 10, 20, 30, whatever it is, up to your capacity, but prioritize first. That this is something that I want first. I need to make a real estate in XYZ city. That's my first and the foremost priority. Work on that first, and then follow the other things that follow. Right? So, this was the goal. This is the first step. As I discussed, this is the first step towards reaching, or maybe towards the ideal investment planning journey. The next is to understand something called as a net worth and a cash flow. Net worth, cash flow, and budgeting. See, what happens is, once again, I think COVID is the best example where I can explain to you about what exactly cash flow and net worth is. For For example, the big companies of India, all these big listed companies of India, they have a lot of machinery, they have a lot of plants, they have a lot of factories, they have a lot of land parcels. They are asset rich companies. But due to this COVID and lockdown, the cash flow is messed up right now. They are not getting that type of cash flow, and hence that effect has been passed on to the employees as well and to other stakeholders, the government taxes or maybe suppliers. But let's talk about the salaried class. They have been impacted by this cash flow hit, and some of them are also out of their job. So what happens is, it's important to make sure that your cash flow are in place. If you start on your investment journey, which requires you to invest regularly on a monthly basis, you cannot simply plan it randomly without knowing that what can your cash flows be for the next 15 to 20 years. So even though your net worth might be high, you might have a lot of assets, you might have a lot of real estate, you might have a lot of gold, but some things require cash, and cash is important, and hence the cash flow is important. When we talk about budgeting, see, I met someone that day who was telling me that I earn 100 and I saved 20 rupees out of it. I was very happy, and I told him that's a good job because you're saving 20% of your salary. But then I asked him, what's the proportion or what is the type of expense you're doing of the remaining 80? So he told me that I don't know. I said, go back, check your statements, and come back to me. What is the type of money you are spending out that 80? He came back to me. He told me that see, I spent 10 rupees on travel, 20 rupees on shopping, and 50 rupees on eating out. Fine dining and XYZ. But what he told me was that, listen, I'm also shocked. Although I know now that what I'm trying to do, where am I spending my money, but I'm also shocked that I never thought that I'm spending such a major chunk of my income, that is 50%, on eating outside. So that gave him an insight, and hence budgeting comes into picture. Although you're saving 20, that may be the last balance that you can see in the balance, in your bank balance, after spending everything that you can, and you consider that as a saving, but it's better to go reverse. Apportion how much you should save, and then out of the leftover money, try to plan how much you can spend under which heads. So he was successful in actually reducing that 50 to 40 and increases saving from 20 to 30. So that gives him a sound financial plan and a sound space to invest more so that he can achieve those goals in a faster time. Now somebody tell me that why do I need to plan so much? I have a credit card, I can just swipe and then just consume whatever I want. But again, you need to remember, this has to be repaid by you, and if not repaid in time, it can cost you heavy interest charges. So it's avoidable, because till the time you can plan things for yourself, let's avoid using credit cards and other things. Now, the most important thing that comes into picture, many people say that, okay, I'm ready. I have written down my goals, I have my cash flow in place, I have my net worth in place, and I made a budget. Now, let me start investing. So, okay, we made a plan for you. We made a plan that, okay, you'll be working for the next 15, 20 years, you'll be saving XYZ amount per month, and we'll reach a target for you. But the most important thing is, just imagine you are the sole karta of the family, right? You are the sole person who's actually earning, and we started your journey of financial planning, and we are in the second year, and something happens to you, and you are no more. The family was dependent on you, right? The plan was good. We were going to survive for the next 15 years on that plan, but now you are no more. What should we do in this case? You are not there after the second year, the entire plan goes for a toss. Hence, it's important to understand that insurance is something that we need to take at an early age so that we can get a competitive pricing for the insurance that we are trying to take, so that if anything unforeseen happens to the karta during the financial journey, he can make sure that the family gets a hefty payout from the insurance company of whatever amount he has taken. We'll discuss about that later. But that money comes to his family so that the family is in a position to at least establish themselves and move forward. Right? So that is the importance of taking an insurance in a financial planning journey. Now, there are various types of insurance that are available in the market. I don't think I have to take you through each and every one broadly, but they are like a life insurance, a disability insurance, a theft insurance, household insurance. So as per your need, whatever is the problem or whatever the things that you're facing, you should go ahead with that type of insurance respectively. Now somebody asked me, do I need to have all of them? So again, the same thing. Now, if you think you have a lot of valuables placed inside your house, you should go for a household or a theft insurance. You think you are a CEO, CXO, a very big personality in some of the company, and you are the sole karta, then you have to have a health insurance for yourself, a life insurance for yourself, key man policy for yourself, and so on. How much insurance do I need? Again, it subjects from a case to case basis that what is the ideal insurance that one needs to take. But on an average, it's recommended that insurance should cover. So, for example, if you're earning 100 rupees today, then it should cover at least 10x to 15x of your annual salary, so that that amount can come to your family at a lump sum, and they can discharge all the pending liabilities that are there on you currently. Right? Now, before moving on, once again, I think we all want to understand, okay, now how should I start my investment journey? But just before we start an investment journey, once again, I want to explain two more important concepts before actually reaching that investment journey. The two more important things are emergency funds and debt reduction planning. Now, again, COVID is once again the best example to tell you about what an emergency fund exactly means. You had your insurance in place, you had your investment plan in place, and there might be possibilities that the investment plan was made for a longer goal that we were trying to set, and hence the money is locked in. And the COVID strikes us, and we are all locked. A lot of people have undergone salary cuts and are also faced a job. They have been removed from their jobs. They've been laid off. Now, what to do in this situation? So it's always advisable to have liquid, maybe in a bank account, maybe in a liquid fund, or any type of accessible area in cash that can take care of at least 3 to 5 months of your monthly expenses, so that you can live during that time. Anything can happen. Right now it's COVID, but maybe you are fired randomly one fine day. So we don't know what is going to happen, what type of emergency is going to come up, who can demand money randomly from you, maybe for your past liability. So always have an emergency fund, so that your financial planning journey doesn't get obstructed because of some random payout that you need to make out of some uncertain, unforeseen events that take place. Again, can you use credit cards for emergency fund? See, you can use it, but once again, you are the sole responsibility is for you to repay them, and to repay them on time. Hence, if you don't do it, you'll be charging interest. So always use credit cards with caution. Last thing before we go on our journey to start investments is to try to save money first. Now, it's a debt reduction plan. A lot of times what happens is we enter into a loan agreement, and generally those loan agreements for a real estate and business loans, they're actually somewhere 12 years, 15 years, 20 years. The horizon is very huge. You take investments for that type of huge horizon. Now, when you enter, so for example, if you entered into a loan agreement 10 years ago, the loan rates were say around 12 to 14%. Today, the loan rates are somewhere around 6 to 8%. Now, you got into a loan agreement at that rate that was existing 10 years ago, 15 years ago. Approach your bank, ask them for a restructuring in this loan at the prevailing interest rate regime. What will happen is you will start saving money on the interest payments that you are going to make to the bank. And let us not forget, money saved is equivalent to money earned, right? So I think these are the things that you first need to understand before we actually start embarking on our journey towards investment. Let us not start putting money randomly into any product that comes into our journey. Let's start with a goal. Let's understand what is our net worth, what type of cash flow are we going to expect in this journey. First, take a sound insurance for your family, for yourself, so that they are not left miserable on your departure. Have an emergency fund for yourself. Reduce your existing debt by all the possible means, so that if something happens, there's not a specific liability that comes on you, and then go on this investment journey, right? Now, investments broadly, once again, they are categorized into two different heads. One is a guaranteed investment, and one is a non-guaranteed investment. And obviously, majority of people, once again, as I said, they fall under the lower category in that pyramid, where they just go and invest randomly into investments and insurance. Again, a majority of investors also fall in this category. That is the guaranteed return investments. Now, what is the problem with this? These returns actually give a lot of comfort to you as a person. Back of the mind, you like things to be predictable. You don't want things to be uncertain, and hence, what happens is you end up taking, a guaranteed return investment, which is going to give you, say, somewhere around 5 to 7% of returns. Sounds good, gives us a lot of confidence. We do not want any type of uncertainties in life, and hence we go ahead with this product. But there's one big thing that is not explicitly told to us about these guaranteed investment products, which I will highlight in the next slide. But for now, yes, these products give a guarantee, almost a virtual guarantee, and are risk free. But then we have these non-guaranteed return investments. We have equity, we have gold, we have commodity, we have real estates, and we have ULIPs. ULIPs are those unit-linked insurance plans, which is an insurance that's a combination of return, savings and protection. So these are non-guaranteed products. And by equity, let me make myself clear when I'm going to talk about equity in this presentation. So equity will all be about taking a bet on India, on India's two top indices, Nifty and Sensex. So I'm not going to talk about trading or taking stock selections, taking positions into some few random stocks. It's going to be betting on India as a whole, betting on the top two indices, and that is what I mean by equity in my presentation. So these are the non-guaranteed return investments. And if you see, when I say guaranteed investments like an FD can give you 5 to 7, something like equity in the past. So since the inception, 20, 30 years on an average, equity has given 14 to 15% on an average return. But still, there's one more thing that I was talking about, why guaranteed return investments become somewhere problematic. So let me give you one small example. We all have come across, some of the other families wherein, parents tell us that, okay, these people were very rich, a few years ago, they had a lot of money and their generations were rich. But today they are normal middle class people, they not even fall, on the upper middle class, or maybe they're just middle class people. And they are shocked, that someone who had so much money a few years ago, say 10, 20, 30, and today they are not even considered rich. What's that factor? What's that invisible, silent factor that actually erodes this money from them? Right? This is the invisible thing that I'm talking about. This is inflation. When, if you can ask your parents, maybe if you wanted to go out and maybe eat out with your family, 30, 40 years ago, you just needed rupees 50 in your pocket, right? You could have had everything from a 5-course meal, from starters to dessert, and have a good meal for your family. But today, if you want to go out with the same family and have a decent 5-course meal, I think 1,000 to 2,000 is not a small number at all. Now, what is this rise? What is this rise from a 50 to 100 rupees to 1,000 to 2,000? What is it exactly? This is inflation. And the worst part about inflation in India has been that in the last 50 years, if you see the data of the last 50 years, the CPI, that is the Consumer Price Index, it has given an inflation of 8% on an average. So the Indian economy, the Indian market has seen inflation of about 8%. Right? Now, we have to understand that if inflation is going to grow at 8%, and if our fixed investments are going to grow at a 5 to 7%, are we going to make money or are we going to lose money? Right? Hence, we need to actually explore the other options of a non-guaranteed return investments like equity, wherein they have demonstrated in the past, they have given a 14 to 15% average return since inception, and hence they are in a probable zone that yes, they can beat inflation. Right? This is a small, working that I've tried to give, which gives a comparison. I will not get into each and every number, but it's a small comparison between FD savings account and what type of returns they promise and what is the type of inflation that takes place. And in the end, is it that we are going to make money or is it that we are going to lose money? Right? Now, Other factors that you need to also understand when you take a decision to whether invest in a guaranteed or a non-guaranteed investment is always that you need to understand that the liquidity is also important for you. If you have your cash flows mapped accordingly and you know that you might want to spend money in some time or maybe the next year or the next 1 year, you need to have liquidity in hand. You cannot go out and block your money for 5 to 7 years or go and block your money for 2 to 3 years or get yourself locked in any type of money. This is an important factor when you make a decision. Now, whether it gives you a inflation beating return or a return that is less than inflation, that's secondary. If you require money, that's primary. Tax benefit. Now, obviously, government also wants you to save. Government wants that people of this country save and not consume everything, because savings for a country are also important. The more you save, the more money the banks get, and the more the money banks get, they're in a capacity to lend more. What happens is government has given a lot of tax breaks. The government has given a lot of tax benefits. You invest in pension schemes, you invest in provident funds, you invest in the mutual funds that give you tax benefits. So they're trying to promote savings through this, and we should always consider that if the government is giving us some type of tax benefits under different sections of Income Tax Act, we should take use of them and try to have a comparative analysis that should I go with it or no, but we should consider this. And the last thing I think that everyone knows about it, risk versus reward. I think everyone knows that if you take a higher risk, you stand in the chance that you might get a higher return as well. But if you don't take high risk and if you take a low risk, you are certain to get some type of fixed return that comes along your way. So it's a normal thing that we need to understand that if you are targeting a high return, if you want to beat that type of inflation that's there in the economy, it's somewhere important for you to become little risky. But that's again an individual call. Now, understood. Everything is good. Things were going good till here. I can understand what type of asset equity is. It can give me higher returns, though it is volatile. But yes, it can give me higher returns. What type of returns an FD is going to give me, and that's another type of asset allocation. Gold exists. A lot of people in India have gold. Now, there's an interesting study. The question actually comes out that now what should I do? I understand that, okay, this is a guaranteed investment, this is a non guaranteed investment, these are the type of assets that fall into place. But how do I know that how much should I put in equity? How much should I put in debt? Because I need to plan, right? My goals are separate, my time horizon is different. Hence, I need to know where and what to do. So it's an interesting study. Okay, it's an interesting study done by the US economist on the US pension funds, where they have actually tried to regress and they've tried to do some statistical analysis on these pension funds. And what they've actually come out with is that asset allocation, the way you try to allocate your money in this journey is responsible for the returns that you end up making at the end of this journey. So when I say, invest in say FD or a debt, it's not important that you go to XYZ bank and do the FD or select ABC bank and do an FD. What is important is to do an FD. If that is the type of asset allocation that suits you. If the asset allocation says you want to do, you have to do an equity of say 50% of your net worth, then it's not important for you to choose whether I should do an do my investments on Nifty or do my investments on Sensex. It's about having an investment in equity as an asset class. So this is the single most important factor which contributes to your returns in the end of this journey. But then there are some factors that we need to keep in mind before we actually go out and allot our assets. For example, time horizon. If somebody who is in the age of 25 to 30 years old, he has his entire career in front of him. He has around the next 30 to 40 years where he can actually spread his investment journey. Why should I even ask him to go and save his money in an FD for the next 40 years? If he is going to stay invested, he has a long journey in front of him. He can see the the volatility. He can withstand it. I will recommend him that, hey, go there and invest in the equity portion. Because you need time to get returns in equity. For example, somebody comes and tell me, listen, I have a very high risk appetite. I have no dependents right now. I am not married. I live with my family and I have a lot of surplus money. And it's really not a problem for me to go out and invest in risky assets. then again I will not tell him that go out and buy gold, because gold is not risky. I will not tell him go and buy gold from your money. I will tell him that go and invest in equities, because that is where the risk is, risk applies to equity. For example, other factors like different life stage. If somebody is on the verge of getting retired, he's 55, 60, 65, he is entering his golden era of his lifetime, and I obviously cannot tell him that, sir, go and invest into equities. He needs money to live. He has already worked for the next 20 to 30 years, and now he needs that money. So I will ask him, sir, go and invest in safe assets. Get yourself, a savings account. Get yourself some debt funds. Get yourself some FDs, so that you can get the money from it and you can live your life. And then some. There are some other factors like past experience. What is your net worth? What type of what is your individual liking, what are your individual desires, and accordingly we try to allocate your asset allocation. Now, why is this important? As I highlighted earlier, it was a study done already, and there are many studies that have followed after that economist, which actually squarely hold asset allocation responsible for your investment journey's return in the end. And again, when we live as humans, we need a balanced diet. We need all types of nutrients in us at different points of time. If you are a blue collared worker, and if you are exerting physically, you need a balanced diet, but which has a lot of carbs, which have a lot of protein. If you're having a sedentary lifestyle, you work on the laptop full day, you don't move much, you need limited amounts of those nutrients in you. But then again, you need a balance. You cannot have 100% of say equity allocation, you cannot have 100% of gold allocation. You need to have a fair balance, need to understand where you stand and when you want to go, and accordingly have an asset allocation. Again, which type of asset allocation is best for me? As I said, it depends from a case to case basis. As per these factors, what is the type of risk you are ready to take, what is the type of time horizon that stands in front of you, and what is the different, what is your life stage? Are you retiring? What is your past experience? Have you, suffered from, a bank failing and your FD being locked, or putting your money in some equity and seeing a lot of fall in the markets? So you need to understand that, and then, try to do the asset allocation for yourself. Now, everything is very smooth till here. We know what to do. We know what are the different types of asset allocations, existing in the markets. What type of investment options are available. I have my insurance in place and my investments in place as well. Now, what happens is there's a lot of uncertainties in the market. Everyone goes through these type of uncertainties. There are times when the markets are going up and everyone is happy. There are times when the markets are going down, and as an individual, maybe you are too busy with your own thing, and hence you are not in a position to maybe understand that what really is happening with your money. So the important thing here once again is we need to understand that with every rise that takes place in the market, and with every fall that's coming down in the market, there is something called as a rebalancing your portfolio at different times of the market cycles. Now, what exactly does rebalancing mean, and how does it help you? So let me give you a very simple example. Say you have 100 rupee and your financial planner sat with you. They made some type of decision, and you try to actually figure out that, okay, what should we do now? 50 rupees is actually allotted to your equity portion, and say 50% is allotted to your debt portion. And suddenly we see COVID that strikes us today, and the markets fall down by 30%. That is the equity. Rebalancing will ask you to remove some portion from your debt, because we have an opportunity in the equity side which has fallen by 20 to 30%. Let's remove some amount from here and try to put it in the equity. Let this equity rise for some time, and if you think that your target returns, as we said that we are going to set our goals, we'll have a short-term goal. So if you made a short-term goal of say 15% from this money, and if that 15% is hit, let's get out again from this asset class and let's go back to where we were and try to rebalance. This simple exercise, okay, a lot of people once again don't do it. What happens is they end up having a passive portfolio where they invest and forget about it. It's like a fill and shut thing. They go ahead and let time decide. Let the time decide whatever happens to them in their investment journey, and then they're happy with that outcome. But the most important thing is that if we can do this, if we understand rebalancing, if we have the bandwidth, if we have some person who's going to monitor this, who's going to take care of the market movements, who's going to suggest us what has to be done at different point of time, you can actually in this entire journey end up making superior returns than a portfolio that is actually making a passive return. Now, these are few examples, which I've already tried to cover. One example that what type of, asset allocation is important. Again, there is one more thing that I'll just try to highlight one more example here, which is a point two. When equity markets give you an expected return, right? The example that we just discussed. So, for example, Sensex, it jumped from 2008 to 10 from a level of 8,000 to 20,000 in a matter of 2 to 3 years. What should you do in this moment? If you understand rebalancing, you need to exactly remove some portion from your equity and get back into your debt because the markets have gone very high. The markets have almost doubled. Let's book some profit, get out, put money back into the desired asset allocation that we had decided earlier, and then move on the journey and again wait for some opportunities when the markets again fall by a 10-20%, whatever has been defined by you. This is the entire idea of rebalancing. Now, this entire journey where we start from actually deciding your goals, we understand what type of net worth, now we took an insurance for you, we made a plan, we went out and we invested, we constantly monitor the investments, we try to rebalance them, and in the end, in this entire journey, you're going to have a lot of money for yourself. I'm very sure this entire process, if done seriously, you're going to have a lot of money for yourself. And this is the reality, this is the universal truth that as an individual or as a family, you will not be in a position to consume everything that you have saved. Right? It's practically impossible. You cannot eat every money, you cannot buy out things from that money. You will have to somewhere give that money to someone, maybe your offsprings, your family, some charity, but somewhere the money has to go. And this is also an essential, very essential, part of financial planning, wherein we need to understand what is a will, right? This is again a taboo topic. Nobody in India will like to talk about will as a, as an instrument, as a estate planning measure, because nobody wants to die. People think that will is synonym, is a synonym to maybe near death or calling death for oneself. But that's not the truth. Irrespective of the type of money that you save in the end, maybe it's a 1 crore, 100 crore, 10 crore, or even a 10 lakhs, that money is going to go to someone. And why do you want that when you are no more, there is uncertainty about, who should get that money in what type of proportion? Even in the past, we have seen, big corporate houses in India fighting for their, parents' share in the end. When their parents were no more, we have seen those type of cases. Endless court battles, emotional battles, financial pain. Why does anyone want to go through that? One more thing, one more very important thing. How many of you all, who are attending this, do actually know that what type of money the Karta of the family has invested and where all has the money been invested? A lot of us are not aware because the Karta of the family has taken the decision over so many years and the entire family doesn't know that what type of money is lying where, in which bank account, what type of gold investments, what type of insurances policies, what type of mutual fund investments, has he lent money to someone? We don't know all those things. Hence the importance of will. Will is a very simple document. People have a misconception that I don't understand these legalities, I don't know how am I going to, write a will, who is going to register it. There are a lot of ambiguities. But let me tell you, will is a very simple document. This document can be written on any type of plain paper, signed by you and a few witnesses around you. Even that type of will is considered legal. It is valid, but is obviously advisable to get it registered. But if you if for some reason you don't want to get it registered, you don't want to get into those hassles, at least write a will. Make a note of what are your assets, what type of liabilities you hold right now, what type of assets you have, what are the different bank accounts you hold, what are the different folios of your mutual funds, and also try to write what type of money you want to give to whom once you are no more. Whether you want to give the money to your child, whether you want to give money to your spouse, whether to your parents, some charitable institution, anything, make a note of it, right? Because as per the data that the Indian government has given out, around 15,000 crore of unclaimed money lies pending, lies idle in banks. That includes dividend, bank balances, a lot of mutual fund amounts, and nobody has ever come to claim it. And this number, I'll tell you, is of 2013 approx. So I'm sure this number has gone up, but these money are lying idle. Nobody knows this money belongs to whom. So let us not get into that type of a scenario. Some important parties, let's take an example that you are making this will for your sibling, your younger sibling who's a minor. So, so let's say you are an adult and you are trying to make a will for minor. Now, when you are no more, you need someone who's going to take care of this will, who's going to get it executed, who's going to make sure that whatever you've written goes to the beneficiary. The executor is that person. Now you can make your CA, your advisor, your family members, your friends, anyone as an executor who's going to take care of this will once you are no more. The beneficiary, as I said, you are making this will for a person who's your younger sibling, who's a minor. So in that case, this becomes the beneficiary. There are two types of power of attorney. Actually, power of attorney means you give someone else the right to do something. So in case of minors, generally we see that we need a type of attorney for taking personal care of that child, to be responsible for his upbringing, and also a power of attorney for his financial matters. In this case, for example, his school fees, his monthly expenses, his yearly expenses, and all these things that the power of attorney is going to take care of. So now I think we have tried to actually reach the end point almost of our financial journey, where we started from investing and then we accumulated the money, and then we have this will which ensures that the estate is transferred to anyone in the future smoothly, and there is nothing that's lost in transmission. But let us not forget that again, investments, actually this entire process is a continuous process. Right? You cannot behave in this manner that okay, I sat down today for 10 hours, I made all my goals, I made my allocation, and that now I'm not going to touch it. As we discussed, passive is always going to give you lesser returns as compared to an active management broadly, because you need to check on what you actually made in the initials. For example, your goals might change. 5 years, 10 years down the line, the goals might change. The current situation of stress might change in the next 10 years, maybe next 5 years. The markets will bounce back, the economy will go strong. What type of risk are you taking? You need to understand you are young, you took a higher risk. When you become old, you are not going to take that type of risk. Hence, you need to keep on making changes, change your asset allocation, change your goals. Once your goals change, your risk change, the implementation will change. There will be regular monitoring from every person who's, trying to manage your money. And that's how this financial process will make sure that you have a surplus amount in the end for your life, so that you can achieve the financial independence that you're striving for. Right now, again, if you want to just have a very small example in this, there are a lot of people, you can see a lot of people who actually face this problem. You might have seen these type of people in your industry, your office, who have passed this age of 60, 65, 70, but they're still coming to office. And it's not that they love to work, it's their responsibilities on their head. They have to come, they don't have any other option. They have to come, they need to have that type of money so that they can sustain. We should actually blame poor financial planning for this. Because if somebody held his hand that time when he was starting his journey, if he understood the basics of something like as basic as an inflation, and how we can actually overcome that. If he understood the basics of market, somebody just taught him about all these things, what type of asset allocation he needs to have, I'm sure he would have, a better future for himself when he actually has to retire, but has to come to office in a very troublesome manner. And I actually will not hesitate to actually call financial planning as a science, because it surely has a cause and effect. If you give enough attention, if you give enough monitoring, if you balance it, if you have enough information, everything is taken care of. Let me tell you, it can actually make sure that you retire far, far, far more wealthy than you can think. As of now, which the path of randomness, where you are actually not planning anything, but just going out and investing maybe for your return filings, or maybe some suggestions or some tips that you get, from a lot of people without a plan. It's just like saying you want to reach somewhere, and the first step for it, that is, you need to go out and book a ticket, but then you don't know exactly that where you want to go. What are you going to tell the ticket checker, or what are you going to tell the ticket seller, that I need a ticket for this destination? It's something like that. And I would like to end this session by asking a few questions to everyone who's listening, and have a thought about it. Have you planned about your asset allocation? Have you ever made a statement of what your financial plan actually looks like? What type of, what is your net worth today? What type of money is invested into safe assets? What type of money is invested into risky assets? What is the time, what is the amount of risk, quantified risk that you are actually sitting at? What is the budget? Are you making some budget for yourself? Are you keeping a track of money that you spend, or are you just relying on the amount that is available in the end of the month? Income minus all the expenses naturally becomes your savings. Are you doing that? What is the target you are taking for yourself? Again, if you're just investing without a target, you don't know when to exit, and you end up actually exiting at a loss, because you keep waiting, it will go up, it will go up, I'll get more, and then when it starts falling down, you don't want to exit because you think that I can't exit things at loss. So what is the target? And the most underrated and the most important, which looks very childish, goal setting. Have goals, written goals for your, at least for your financial plans, because one day or the other you will have to retire. And I'm telling you, ask those people who are not able to retire peacefully with a reasonable corpus in their hand, and hence they are forced to travel, forced to work, forced to sacrifice the time that they need to have and spend with their family, and still come to work. I leave you with these questions. I'm sure you will think about those, and I will open up the panel right now for a few questions. You can send your questions, if any, through chat. I will try to respond to the most relevant questions, and if there is anything in detail you want to understand, we can connect on social media. I'm available on all the social media platforms. Thank you once again for being a patient audience. I'm sure you must have taken something from this, at least something as basic as goal setting also. It will be wonderful. If any questions, I'll stay here. You can please post your questions on chat, and I'll respond to them. Thank you, thank you so much.